Hello students, welcome back to Standard 6 Mathematics Digital class. Today we move on to lesson number 14, Banks and Simple Interest. This is a lesson included in the first term of your academic year. Many of you might have visited a bank with your parents. The picture shown in the video may be a familiar sight to you, or you must have seen a bank building from the outside. Now what is a bank? A bank is a government-recognized organization that carries out transactions of money. Now, you all know that your parents earn money by going to work. We must save some part of the money that we earn for future use. This may be used for many things like education, building a house, medical treatment, etc. Small savings made regularly become a large amount after some time. These are a few people who use the banking services. The banking services are open to farmers, students, traders or businessmen, industrialists or professionals, and also the saving groups. You can have a group account also in your bank. To use banking services, one has to open an account in a bank. So, to open an account, we require the following documents or papers. First, the proof of residence. For this, you can use your ration card, your electricity bill, telephone bill, identity card, the domicile certificate, etc. Any one of this should be provided to the bank. The second thing that you need is your proof of identity. For this, you have to produce a copy of your Aadhaar card, voter's identity card, PAN card, passport, or any other proof suggested by the bank. Some banks also ask for a reference from another customer who is an account holder in the bank. Now let's see what are the facilities provided by the bank. The bank gives a passbook to the account holder, a checkbook, an ATM card. It also provides the facilities for mobile banking, SMS banking, and internet banking, which are currently in use. Now let's see these things one by one. A passbook. I know many of you might have seen this book with your parents. A passbook is a specific kind of record keeping method. With a passbook, the account holder actually keeps track of all the transactions in a little notebook that the bank provides. Now, a passbook actually records all the transactions that you do, whether it is depositing money or withdrawing money. It keeps a track of that in the book called the passbook. Now this book is provided by the bank. Checkbook. A book containing detachable blank checks and issued by a bank to holders of check accounts. Now this book contains a number of leaflets which you can use for paying money. You can pay money during your shopping or pay money to anybody using this check. A check is nothing but a written bill of exchange that is written by a bank account holder to pay for goods or services. Now this picture is a very familiar one. This is called the ATM or the automated teller machine. This is a machine that dispenses cash or performs other banking services when an account holder inserts a bank card. Now these are the different bank cards which are available, or you call it the ATM card. An ATM card is a payment card issued by a financial institution which enables a customer to access the automated teller machines. There are various types of bank accounts which are maintained by an account holder. The most important ones are the saving account, current account, recurring deposit account, and fixed deposit account. Now, what is a saving account? Now, a saving account is meant to induce a habit of saving money. An account holder can deposit money in the savings account as and when money is available. He may also withdraw some money from the account occasionally if needed. Banks give an interest of 4% to 6% on the money in the savings account. This keeps varying. In a current account, money can be withdrawn from it any number of times, but one does not get any interest on the amount in this account. In the current account, you won't get any interest, but you can withdraw money any number of times. To get more interest, we have to keep a fixed amount in the bank for longer periods of time. So the recurring deposit scheme and the fixed deposit schemes are used by the account holders to get a better interest. Now, you all must have used a piggy bank to save your pocket money. You must have saved small coins given to you by your uncles, aunties, etc. Now, what's the difference between a piggy bank and the real bank? Now, we saw earlier that the bank is a place where you store money. Unlike your piggy bank, the banks pay you for keeping money with them. This payment is what is called as the interest. This interest is paid to the account holders. They pay you a small amount of money as interest on how much money you have in the bank. So the more you have in the bank, the more interest you will earn. But why would they pay you for storing money there? Now this leads to the second thing that banks actually do. Banks allow you and others to borrow money from them. So they'll pay you to keep your money there so they can use that money to let other people borrow to purchase things they need. Say, for example, if someone wants to buy a house, they will come to the bank because most of us cannot pay the entire amount for the house. So the bank will give them money and they must pay it back. However, when they pay back, they must pay back a little more than what they have borrowed. And this again is known as interest. But this is a higher interest. For example, Kiran deposited 1000 rupees in a bank. The bank has promised to pay her rupees 100 every year. Now Raju wanted to buy a bicycle. So he borrowed 1000 rupees from the bank. But when he returns the money, he will have to pay 1200. Now here the bank is earning 200 rupees by lending 1000 rupees to Raju. So this is how the bank earns money to pay your interest. So if you see, bank is a place where money is stored and borrowed. You can earn an interest in the bank, and the banks earn an interest when people borrow and pay it back. And that interest they are using to pay the depositors as interest. Now let's see the calculation of interest. There are a few terms related to the calculation of interest. The first one is principal. Now this is the money deposited in the bank or the money lent by the bank to a borrower. Okay, so when you borrow 1000 rupees, that 1000 rupees is what is called as the principal. Interest. Interest is a payment in exchange for the use of money over a period of time. You can earn interest by lending your money to a bank, and also you can pay interest when you borrow money from a bank. That is, interest is the extra amount that you receive from the bank when you deposit money there, or it is the amount that you pay back to the bank when you borrow money from the bank. Rate of interest. When calculating interest on a deposit or a loan, the rate of interest is given for every 100 rupees. The rate of interest is given for a period of time. A rate of interest, that is percent per annum, is written as PCPA, gives the amount of interest due on every 100 rupees for a period of 1 year. That is annually. This is normally written as 10% per annum, 12% per annum. What does it mean? If it is 10% per annum, it means that for every 100 rupees that you have borrowed, you will have to pay 10 rupees extra at the end of 1 year. Or if you have deposited money in the bank, for every 100 rupees, you will get 10 rupees more at the end of 1 year. In this class, you will be learning how to calculate the interest charge for 1 year. This is the simple interest. In the next class, you will be learning how to calculate the interest for more number of years using the formula for simple interest. Please write down the definition of all the terms that we have studied in this lesson. We will be solving the exercise in the next video. Now in this video, we have learned a few things about the bank. I hope you all have learned the importance of saving money also. Saving a small amount soon builds up to a large amount. Hope the knowledge about the bank will encourage you to save money. Thank you and have a nice day.